You've done everything right. Saved diligently, invested wisely. And now, you're following the golden rule of retirement. The 4% rule. It's supposed to be your ticket to a stress-free future. But what if I told you that for a growing number of retirees, this rule is a quiet trap? A trap that could lead you to run out of money, not because you overspent, but because you trusted one single number for far too long. Stick around, because we're about to unpack why the celebrated 4% rule might be failing, and why a seemingly small shift to 3% could be the key to making your money last a lifetime. Let's rewind and understand where the 4% rule came from. It was born from historical market data. Financial planner Bill Bengen analyzed stock and bond returns from 1926 to 1976 and found something remarkable. If a retiree withdrew 4% of their initial portfolio in the first year and then adjusted that amount for inflation each year after, their money would have lasted for at least 30 years in almost every historical scenario. It was a groundbreaking discovery. It gave retirees a simple, easy-to-follow guideline. On paper, it worked beautifully. For decades, it was accepted as gospel, the safe withdrawal rate. But here is the problem. The world we live in today isn't the world of 1976 or even 1996. The financial landscape has shifted dramatically. First, let's talk about interest rates. For much of the 20th century, bonds and other fixed-income investments offered much higher yields. It's provided a stable cushion for portfolios. Today, we're in a historically low interest rate environment. That reliable income stream is now a trickle, forcing retirees to rely more heavily on volatile stocks. Then there's inflation. The 4% rule assumes a predictable average rate of inflation. But recent years have shown us that inflation can be anything but predictable. A sudden spike can force you to withdraw significantly more money just to maintain your standard of living, putting immense pressure on your portfolio right when it's most vulnerable. And perhaps the most significant change of all, we're living longer, much longer. When the 4% rule was conceived, a 30-year retirement was a generous assumption. Today, retiring at 65 and living to 95 or even 100 is no longer a rarity. It's becoming the new normal. A rule designed to last 30 years simply isn't robust enough for a potential 35 or 40-year retirement timeline. The math just doesn't stretch that far. Now, let's get to the biggest hidden danger of any withdrawal strategy, something called sequence of returns risk. This is the real portfolio killer. It's not about how your investments perform on average over 30 years. It's about asterisk. When asterisk those returns happen. Imagine you retire, and in the first 2 years, the market drops 20%. You still need to live, so you withdraw your 4%. You're selling assets at a low price to fund your expenses. This permanently damages your portfolio's base. Even when the market eventually roars back, your portfolio is smaller, has less capital to grow from, and it may never recover from that early damage. You're trying to climb out of a hole that just keeps getting deeper with every withdrawal. This is where the idea of a 3% withdrawal rate comes in. It might sound like a small change, but its impact is profound. Shifting from 4% to 3% isn't about being pessimistic, right? It's about being realistic. It's a strategic decision to buy yourself the most valuable asset in retirement: time. A lower withdrawal rate gives your portfolio more time to recover from those inevitable market downturns. It creates a buffer. When you're taking out less, a market dip doesn't hurt as much. The hole you're digging isn't as deep, making it much easier to climb out when things turn around. Let's be clear. Choosing 3% has a trade-off. It almost certainly means spending less in the early years of your retirement. It might mean forgoing some luxuries, delaying a big trip, or keeping your car for a few more years. It's a choice that prioritizes financial security over immediate gratification. It's about asking yourself a critical question: what is more valuable? A slightly more lavish lifestyle for a few years, or the peace of mind that comes from knowing you have a much higher probability of not outliving your money? For many, that peace of mind is the ultimate luxury. Truth is, no single number, not 4%, not 3%, not 5%. It's a magic bullet. Your retirement plan can't be based on a universal formula. It needs to be uniquely yours. Think about it. You're planning for a 25-year or a 40-year retirement. What are your potential healthcare costs, which are notoriously difficult to predict? Now, How do you personally react when you see your account balance drop by 20%? Your emotional response to market volatility is a financial factor in itself. If a market drop causes you to panic and sell at the worst possible time, a conservative strategy is your best friend. The conversation needs to change. The question isn't how much can I withdraw? The real, fundamental question is, how do I build a plan that ensures I don't run out of money? This means moving beyond a single percentage point and embracing a more dynamic approach. It could involve flexible spending, where you withdraw less in down years and a bit more in up years. It might mean securing a baseline of income with annuities or other guaranteed products. Ultimately, successful retirement isn't about dying with the biggest possible bank account. It's about living a fulfilling life without the constant fear of your well running dry. It's about ensuring your money outlasts you, not the other way around. In this new era, calm conservative planning will always beat chasing high returns. Financial safety is more important than portfolio optimization. And acknowledging the reality of longevity changes everything. This is Everlasting Capital. We believe in building financial plans that last. It's no hype, no noise. It's just money that lasts. Thanks for watching, and if you found this helpful, consider subscribing for more insights into building a secure financial future.